Using your area survey data and a macroeconomic model, I showed that adjustable rate mortgages amplify policy transmission only when they're held by households that have a high marginal propensity to consume.
I specialize in behavioral macroeconomics, and in recent work I asked, does it matter who communicates policies to the public?
And my work explores the international spillovers of monetary policy, focusing on the role of currency compositions in portfolios in shaping the global transmission of monetary policy.
In particular, I use advanced text analysis tools to study how the inflation expectations of households and experts are related to causal media narratives about the triggers of inflation.
In a recent paper, I explore why women have higher inflation expectations than men.
In this work, we explore the consequences of supply chain disruptions on the German manufacturing sector using a novel identification strategy based on survey data.
I find that targeting these more productive urban areas leads to the largest welfare and production gains at the country level.
We use the US experience to draw new lessons that can inform the current debates on the merits and the importance of completing the EU banking and capital market union.
And I'm working at the intersection of macroeconomics, climate change, and international trade, with a particular focus on optimal economic policies and inequality across countries.
Combine economic theory and empirical data work and find that increasing subsidies can in fact be cost effective due to two indirect effects.
Ladies and gentlemen, it is now my pleasure to turn over to the 10 finalists of the 2025 Young Economist Prize. Each of our finalists is going to give you a brief speed presentation of their findings. Over to you guys.
The planet is warming. We are emitting more and more carbon in the atmosphere, and nobody is doing anything about it, or at least not enough. The economists argue that the optimal solution is to put a Pigouvian tax on fossil fuel. If we make the oil, gas, and coal more expensive, consumers will reduce their emissions and firms will switch to solar and green. Seems pretty simple, but few governments want to do this. Why? Because carbon taxation is costly, and most of the benefit will be borne by other countries. That's the free riding problem of climate policy. But what can we do about it? How can we solve this free riding problem and fight climate inaction? How can we make our planet great again? One solution to promote global cooperation is the idea of the climate club, a climate agreement where members set a carbon tax on their own emissions and set trade tariff against non-members. In my research, I study how to optimally design these climate agreements, and I built a rich quantitative model with a climate system, inequality across countries, international trade, and the country's strategic decision to participate in the agreement. The optimal agreement that I find gathers all the countries in the world at the exception of major fossil fuel producing countries like Iran or Russia. The optimal carbon tax is lower than the Pigouvian framework by 25% and also impose a large trade tariff against non-members. Lowering the ambitions and imposing large trade retaliation is very important to incentivize some countries that would deviate, for example, India or the US. So it allows to reduce emission by 30% and maximize welfare, which would be a first step to fight climate change. Thank you very much.
Good morning. My name is Lunardo Domigo, and I'm graduating from Harvard University, and I will join the faculty at the University of Chicago Booth School of Business. Europe needs to meet large investment challenges, and my research speaks to this topic by considering the process of financial integration of banking markets, by which I mean the process through which the financial sector manages to allow liquidity raised in one location to easily finance loans and opportunities potentially far away. I studied this topic in the context of the US banking sector in the mid-1900s, with the explicit motivation of drawing some new lessons from the American experience about the merits of completing the capital market and banking union in the EU today. To draw these new lessons, my research brings new data from that historical period and a new theory that allows me to study jointly the mobility of financial capital across regions, jointly with the mobility of other real resources, such as labor and goods. So what do we learn from this period? There's two new lessons, both of which suggest that completing the capital market union in the Eurozone today might be much more important than previously thought. The first reason is that Europe comes out of a protracted low-rate environment. The American experience actually shows that low interest rates can breed substantial financial segmentation. The intuition is quite simple. When interest rates are low, households are more likely to hold their liquidity in deposits at their local bank instead of investing in national money markets fund and securities market, which are better suited to redistribute this liquidity across space. Hence, when we come out of a protracted low-rate environment, allowing banks to act as a single entity across space and move liquidity across space is much more important because there's just so much more of that liquidity to be redistributed. The second lesson actually relates to the debate, to what we learned this morning from Benjamin and Nicole, and the debate that we had after, which is the relationship between capital market union and labor markets. In particular, I think a way to reconcile both of the topics that have been raised is actually that what my research shows is that when labor markets are frictional, actually completing integration of capital markets is even more effective. The reason is that, for instance, in the EU, households and workers do not move much across EU countries, as opposed, for instance, to workers in the US. And so when workers do not move much across space, actually allowing capital to do some of that movement can be much more effective. In other words, enhanced capital mobility actually can substitute and enhance economic efficiency, especially when labor is not that mobile across space. So thank you so much.
Hi everyone, I'm Friederike and I'm currently pursuing a PhD at the IFO Institute and the University of Munich. And in our paper, we analyzed the effect of input material shocks or eventually supply chain constraints on the German manufacturing sector. And our paper makes two main contributions. First, methodologically, we suggest a novel bottom-up identification approach where we used microdata to identify a macro shock and by exploiting time series patterns of firms' forecast errors. Second, in our empirical application, we then construct two time series for easing and tightening input material shocks, and we show that their effects on production and prices are asymmetric. A tightening shock leads to an immediate and persistent increase in prices, whereas the effect on production is smaller and in particular temporary. An easing shock, in turn, boosts production, again only temporarily, but now prices take much longer to decline. And in particular, we also highlight that the magnitude of the effect of an easing shock is much smaller than a similarly sized tightening shock. In our paper, we also argue that our findings may be relevant and interesting from a monetary policy perspective and also from a financial stability perspective. On top of that, we believe that given appropriate granular microdata, our identification strategy may also be applied in other settings too. And in particular, the resulting shock series may then provide value in informing in a timely fashion about potential vulnerabilities at the firm level that may also spread over to the broader economy. Thank you.
Good morning, I'm Marisa, and I'm a PhD candidate at Universitat Pompeu Fabra in Barcelona. My job market paper starts with a question. Are entrepreneurs and their capital allocated optimally across space? And should governments employ place-based entrepreneurial policies? These questions are important to understand capital misallocation and the design of entrepreneurial policy, but they remain underexplored. To fill this gap, I developed a rich dynamic spatial model featuring occupational and location choices, financial frictions, agglomeration forces, and endogenous capital accumulation, and then take the model to the largest 20 urban areas of the Spanish economy by making use of rich administrative social security data as well as balance sheet data on firms. In doing so, I obtained 3 key findings that are policy relevant. The first one is that the model predicts and the data supports that more productive urban areas are more capital constrained. Second, in line with this intuition, I find that targeting these more productive urban areas leads to the largest welfare and production gains at the country level. However, this comes at the cost of exacerbating regional economic disparities, which poses a challenging trade-off to policymakers. And third, I find that the design of the policy matters. Lump sum transfers, where the average euro is spent on smaller, younger, more constrained entrepreneurs, leads to larger welfare and production gains than size-dependent policies, such as guarantees or loans, which are actually more common in practice. And so, my research stresses the importance of accounting for space in understanding capital misallocation and the design of entrepreneurial policy. Thank you.
Thanks so much for having me. I'm Patricia from Stockholm University. So one big challenge of the 21st century is how we can organize care for the increasing number of seniors worldwide. Professional care, think for example nursing homes, but also home care, is expensive to seniors, so many seniors rely on their family members to receive care. A potential alternative to this family-provided care is that we make professional care more accessible to seniors through government subsidies. I argue that while such government subsidies ensure the seniors against these large financial risks of becoming dependent in old age, they also must be financed. Therefore, understanding how government subsidies impact not only the seniors, but also their caregivers and ultimately government's budget is important for the design of elder care systems. So in my research, we address these questions and study the economic and health impact of a reform in Sweden that subsidized elder care services in 2/3 of Sweden's municipalities. We do so by combining quasi-random variation with a theoretical model, and we have 3 main findings. First, when we look at the seniors, we find that subsidizing elder care leads also to an increase in the demand for elder care services. Importantly, at the same time, these seniors are less hospitalized, especially they go less to the hospital for conditions that are preventable or treatable outside the hospital setting. Second, when we then look at their adult children, we find that they are increasing their labor supply in response to these subsidies. And what's interesting here is that rather than temporarily adjusting the labor supply depending on how much care the parents need, they are persistently shifted into new higher paying career paths. And then finally, third, when we take these indirect effects into account, so that is how the seniors change their healthcare utilizations, as well as these intergenerational effects on the children, these subsidies can actually pay for themselves and are welfare improving. Thanks so much.
Hi everyone, my name is Louisa. I'm currently a PhD student at the University of Oxford and incoming AP in Finance at the Norwegian Business School. In the paper here, I'm looking at the gender gap in inflation expectations. And by that, I mean the finding that consistently women report higher inflation expectations than men. This is about 2 percentage points, so it's quite sizable if you think about your average inflation targets. Now in the paper, I look at the drivers of this, and in the past, this has sort of been attributed to women in traditional gender roles, maybe seeing more food prices than men. Now I show that this is not the full story, and this is actually missing one really crucial finding, which is that confidence also matters a lot for forecasting. And we know that women have lower financial literacy and lower forecasting sort of confidence. Now, I show this using the data from Germany and the US, where I show that closing the confidence gap would actually close the gender gap. But more importantly, those that have low confidence, they rely a lot on the prices of groceries, whereas those with high confidence, they do not. Now, I show this also in a Bayesian updating framework, where if you think you have a flat prior, then signals matter a lot more than if your prior would be very precise. I think that this is a finding that is very important beyond gender, because it shows that anything that sort of reduces your confidence, and this may be age, this may be income, this may also be the geopolitical climate actually, brings you to rely more on the price of like simple local signals, such as maybe the price of butter. And this actually helps us also to explain sort of broader patterns and heterogeneity beyond the gender gap, and helps us to sort of stabilize inflation if we target confidence more through improving financial literacy of everyone. Thank you very much.
Good morning. My name is Joani. I am from Italy, and I just finished my PhD in economics at Northwestern University. There is a problem in the euro area, which is that the transmission of monetary policy is very heterogeneous across countries. Now, this represents a problem because it implies that when the European Central Bank implements its policy actions, they will have very different effects on the different countries that are part of the Union. As a consequence to this, it is crucial to understand the underlying reasons that explain this heterogeneity in transmission. And this is precisely what I do in this project by focusing on one channel of monetary policy transmission, which is the mortgage channel. There are two questions in particular that I'm after. First, I want to understand precisely how monetary policy is transmitted through adjustable mortgages in the euro area. Second, I want to quantify the extent to which differences in transmission across euro countries can be attributed to differences in transmission through adjustable mortgages. In order to address these questions, in the first part of the project, I implement an empirical analysis where I show that in the euro area, the strength of transmission is particularly high in countries that have both a high share of adjustable mortgages and a high fraction of households that are liquidity constrained. Based on this finding, in the second part of the project, I build a quantitative model with heterogeneous agents. The model shows that in order for adjustable mortgages to be a powerful vehicle of monetary policy transmission, they need to be matched with high marginal propensities to consume, since marginal propensities to consume control the sensitivity of consumption to changes in mortgage payments. In addition, I also use the model to show that approximately 40% of the empirical differences in transmission across euro countries can be attributed to differences in transmission through adjustable mortgages. Overall, there are two key takeaways from this project. First, adjustable mortgages and marginal propensities to consume interact in powerful ways for monetary policy transmission. Second, differences in transmission through adjustable rate mortgages are important in order to understand the overall differences in transmission across euro countries. Thank you.
Hello, everyone. I'm Jacob, and I'm a PhD student at the University of Copenhagen. My paper tackles a classic question, which is what happens to the rest of the world when the US tightens monetary policy? The traditional answer to this question is that when the US sneezes, the rest of the world catches a cold, meaning that the rest of the world goes into a recession. I confirmed this in the data, but only when looking before 1990. Instead, today, it's no longer the case that a tightening of US monetary policy creates recessions abroad. So the question is then, what is driving this change in spillovers? And here I point to a structural shift in the US economy over the same time period, which is that the US has gone from a net creditor to a net debtor. This means, on the flip side, that foreigners now hold significant dollar wealth. And how may this change the transmission of spillovers? Well, consider the following channel. When the US tightens monetary policy, the dollar will tend to appreciate. This means that the foreigners' holdings of dollar wealth is worth more, which creates a positive wealth effect on consumption. I test this channel empirically using a panel dataset of 37 small open economies. Here, I find that countries that hold more dollar wealth are indeed more insulated from the tightening of US monetary policy. I then built a 3-region New Keynesian model with partly dollarized balance sheets. And in this model, I find that the dollar wealth effect on consumption is driving most of the change in spillovers. In this sense, my paper challenges the conventional view that when the US sneezes, the rest of the world catches a cold. And in some sense, it's really a success story about countries avoiding foreign currency debt on their balance sheets. Thank you.
Hello everyone, my name is Joani and I'm graduating from Tilburg University. My work studies whether the inflation expectation gap between households and experts can be explained by narrative disagreement between newspapers over whether inflation has a demand or supply origin. And I can answer this question thanks to a novel text analysis tool called causality extraction that allows me to extract causal relations from text and determine whether a newspaper attributes inflation to a demand or supply origin. Now, we all know that over the past 30 years, in the US, as well as in many other countries, the inflation expectation gap has been positive and volatile. And in particular, it has been positively related to press coverage about inflation, in contrast with what we would expect based on standard attention models. Now, I argue that this might result from households reading general newspapers that report the views of experts less accurately than more specialized newspapers. So the disagreement might be key here. And in particular, what might be important is the disagreement about the triggers of inflation. As recent survey evidence suggests that households and experts disagree in their views of where inflation comes from. Now, we don't have their time series narrative data, but we can proxy their narratives with the narratives of general and specialized newspapers. And essentially what I show is that when narrative disagreement between general and specialized newspapers increases, the inflation expectation gap widens, particularly for non-college educated households that are farther away from experts, and for older households that are more likely to read newspapers. So the policy lesson here, I think, is that for policymakers to convey their narratives, they need to consider a wide array of channels, as the main channels might not reach households. Thank you very much.
Good morning, everyone. I have the pleasure of wrapping up the Young Economists. My name is Alina Barbage. I just finished my PhD at Oxford, where I specialize in behavioral macroeconomics, and I've also worked on how AI impacts the labor market. I specialize mostly on inflation expectations, how they link to real decisions, and also complexity and central bank communication. In a recent project, I asked, does the messenger of policy communication matter? And I find yes. The messenger can actually positively impact both the reach and impact of policy communication. This happens when the public shares characteristics with the messenger. I explore the role of the messenger in 3 parts. First, I create real-world evidence from Twitter, where I show that when the ECB president shares nationality with the public, there is more information available on ECB press conferences, but also beliefs update more strongly towards the signal of the press conference. In a second step, I design an inflation forecasting experiment, and I show that causally, the messenger impacts inflation expectations in 4 different euro area countries. So they update inflation expectations more strongly to a signal of a messenger of shared nationality. In a third step, I design or develop a stylized coordination model on the social value of public information. I do this to answer a normative question. How should we optimally communicate to the public in light of the messenger effects that I find empirically? And the answer is, what maximizes social welfare is to be strategic with the messenger. Sometimes we should diversify who communicates, other times we should centralize communication. And it depends on the quality of public information. So this makes the messenger itself a policy tool that's available to central banks, but also to governments to communicate their policies on monetary issues, but also fiscal, health, or climate issues. Thank you very much.